Your main goal as an investor is to not lose money. Okay, that's not guaranteed, but there are a few things that we can do in order to put the odds in our favor. Step one would be to not buy crap companies. You're welcome. Now, I know that sounds simple or hard. I guess it depends on you, but don't worry. If you are the type of person that feels like no matter what you do, you can't seem to invest in the right companies, well, this video is for you. Today, we are going to break down the first steps that you will need to take in order to value companies. Now, I know what you're thinking. Alex, the experts try to value companies all the time and they suck at it. Well, yes, that is a good point, but that doesn't mean that we can't try, right? It doesn't mean that we can't do a bit of research on our end to make sure that at the very least, we are buying companies that stand a chance rather than buying a stock simply because, ooh, look, it's going up. Okay, so I promise you this video might seem like a lot if you are a beginner, but don't worry, we're gonna go over everything step by step so that by the end of this video, you will have a better understandings of the basics of how to value a stock. This way, we can take a more calculated approach to our investing instead of, I don't know, putting it all on red on the roulette table as we do sometimes. Now, what's worse than investing in crap companies? Well, starting your own crap company. And this is why I started a free newsletter where I give you 3 business ideas in each issue that you can go ahead and start right away. Now, over the last 20 years, I've kept a notebook, or rather a lot of notebooks of hundreds of business ideas. But I realized something. I'm not going to do all of them, right? So why not just give them away? Now, there is no catch. Just sign up with the link in the description. It's free. It will always be free. And you will get an email every week with my insights of what I think could be really cool businesses. So go ahead, sign up. I would really appreciate it. Thank you. And let's get into valuing companies. Now, the first thing that I want to talk about is understanding enterprise value rather than the market cap of a company. Now, this is usually the stages that one takes from beginner to expert in valuing companies. So first, as a total beginner, like you and me once were, we might take a look at the stock price and that's it, right? So, ooh, the stock is only $5. What if it goes to 100? Or they take a look at a $500 stock and say, oh, wow, too rich for my blood. That's a lot. Now, everybody watching this, I hope, knows that the price of the stock means pretty much nothing when it comes to how cheap or expensive the company is. At least I hope we all know that. Now, a more advanced investor would probably look at the market cap of a stock, right? So what is the market cap? Well, the market cap is how much the company as a whole is valued on the stock market. It's a simple calculation. You take the stock price and you multiply it by how many shares outstanding there are. So companies issue shares, right? Millions of them, and you could buy each of those shares for the share price. So if a company has 1,000,000 shares outstanding and the stock price is $100, well, do a little bit of math, and we can determine that the market cap of that company is $100 times the 1,000,000 shares is $100 million. So far, so good. Now, you might look at that $100 million number and try to deduce whether or not the stock is expensive or cheap if you were to invest in it. But does the market cap tell you the full story? Well, no. No, it doesn't. This is where more expert level valuation comes in. Now, I say expert level, but this is all pretty much standard stuff, so this is very important to understand. So let's go through enterprise value. Now, there's a simple calculation for enterprise value. The EV, or enterprise value, is equal to the market cap of a stock plus the debt minus the cash. And we're going to go through each of these scenarios to understand this equation because it's very important, okay? So let's take a look at an example. So company X, this is going to be our fictional company, and that has, again, a market cap of $100 million. Now, you might look at that on your little stock app and say, ooh, $100 million, and think you understand the value of this company. Well, you might be wrong because every company has a combination of debt and cash, and we have to account for all of that, right? So let's just take a look at the first example. We're only going to look at debt. Let's make pretend that this company has no cash for some reason and it only has debt. All right, so it has debt of $20 million. Well, this changes things, right? So taking a look at the first half of the equation with only debt, you're going to have to take the market cap and you have to add the debt onto it. And I will explain exactly why. So in this case, you're taking the market cap of $100 million. You see that it has debt of $20 million. So the EV, or the enterprise value, is going to be the market cap plus the debt, which is $120 million. Now, why is that? Well, remember that the market cap is how much it would take to buy the entire company on the stock market. So let's just say you made a bunch of money buying weekly out of the money call options, as one does, and you now have $100 million to spare. And you take a look at this company and say, I want to buy that company. Well, in this case, you are going to be responsible for the debt of the company as well. So we need to add this debt into this valuation, right? This is why we add the debt on top of the market cap. So the true value in this case would be $120 million, because we would use that extra $20 million on top of the $100 million to pay off that debt. Now, I hope that makes sense, right? You buy all the shares for $100 million, but you still need an extra $20 million to pay off the debt. So you need that debt on top of how much it costs to buy all the shares. The debt actually increases the value of what you would need to pay for the company. Now, I know this might seem counterintuitive at first, but hear me out. Let's say instead of the $20 million that this company has in debt, it has $100 million in debt. So would it be a good deal if you bought the company for $100 million? Well, let's walk through it. So let's say you pay $100 million for this company. You now own it, but what's that? You still owe $100 million in debt? Well, you need to pay that, right? You are responsible for that, right? So you really are paying $200 million in order to acquire this company. So the debt needs to be added to the market cap in order for us to get a better understanding of what this company is worth to you as a buyer. So again, $100 million, we add the debt, we get the new enterprise value, which is a better number to look at rather than the market cap. All right, now let's flip the script a little bit and talk about cash. So let's make pretend that this same company has a market cap of still $100 million, but now instead of having debt, let's say that the company has $20 million of cash sitting around, either in the bank, in short-term treasuries. They have about $20 million worth. Now, how does that affect the company's value? Well, cash is a little bit of a different story. If we take a look at this equation once again and we take out this part with the debt, you'll notice that the enterprise value is the market cap minus the cash, all right? So we have to subtract the cash from the market cap to get a better understanding of what it's worth. See, while the debt increases the total cost of buying the company since you're responsible for that debt, the cash actually works in your favor. It reduces the true cost of acquiring that company because essentially you're getting that cash for yourself once you own it. So let's break down the example. Market cap, 100 million, cash, 20 million. Again, we have to minus the cash from this equation. So we minus 20 million from the 100 million, and you have an enterprise value of $80 million. You are essentially getting back this cash when you buy the company. Think of it like an immediate bonus that you get when you invest in the company. You have that extra cash that you can pay off debts or return to your shareholders. So in this case, you are paying $100 million for the company, but since you get $20 million in cash, the true cost to you as an investor for buying the company is really just $80 million. Now, here's an example that really helped me when I was first learning this. Okay, imagine that you are buying a house that is worth $100,000, but the house comes with a safe, and in that safe there is $20,000 in cash. So you say, wait, let me get this straight. If I buy this house, you're just going to give me the safe with $20,000 in cash? And they're like, yeah, yes, that's correct. So then you say to him, well, what if I just pay you with $20,000 less? Isn't that the same thing? What if I just gave you $80,000 for the house and you keep the cash, right? It's the same thing. So you as the buyer only have to come up with $80,000 instead of $100,000. So to you, the house is now worth less in your eyes. This is why we need to subtract the cash from the market cap in order for us to get a better understanding of the value of what we are buying, right? Okay, now here is the problem. Companies have a mix of debt and cash. Uh-oh, now what? Well, we go back to our equation. Everything's okay. Let's plug everything in, take a look at an example, and determine the EV of whatever this company is with a mix of debt and the cash, all right? So again, enterprise value, market cap, plus debt, minus cash. So now let's take a look at our final example over here. Let's say we have a new company. Its market cap is $800 million. Ooh, close to $1 billion. Very nice. But wait, what's that? It has debt. How much debt? $600 million. You're like, okay, that's a lot of debt. Does it have any cash? Oh, yes. Look at that. What a coincidence. The next line is cash. It has cash as well for $200 million. So what does that mean? Well, let's plug in these numbers really quickly into the equation. You have market cap of 800 million. We can do this calculation. So we have 800 million market cap. 800. Well, that doesn't work. Oh, okay. 800 million market cap plus the debt of 600 million minus the cash of 200 million, you get a total of now what the company's actually worth on a better scale is $1.2 billion. Okay, so 1.2 billion is now what the company, a better estimate of the company's value rather than taking a look at the market cap of 800 million. Again, this doesn't tell the full story. We have now a new enterprise value, a better estimate of $1.2 billion. You can see that using enterprise value gives you a much better representation of what it really takes to buy the company as a whole. And as investors, this is really important because just looking at the market cap can give us a false picture of that true value, right? And when we buy stock in these companies, we should be acting like we are buying the entire business. Even though we are buying a piece of that business, we still want to buy it at a fair price. So knowing this will ultimately help us make better investing decisions. Let's keep going. All right, now I want to talk about and understand the PE ratio. You hear it all the time, right? Oh, the P is 15 or the P is 22. What does this actually mean to us as investors? Because at the end of the day, when buying any stock, we want to at the very least understand if what we are buying is expensive or are we getting a good deal. The price to earnings ratio or PE ratio measures the current market price of a single share of a company relative to its earnings for each of those shares. Now, in simple terms, it just tells you how much you as an investor are paying for each dollar that the company earns. Now, imagine that you're trying to figure out if, let's say, a chocolate bar is expensive, right? Instead of just looking at the price, you probably would want to look at the price relative to how large or small that chocolate is, right? How much chocolate are you actually getting for that price? So once we understand the concept of how much am I paying in relation to what I am getting, then we can better determine if we are underpaying or overpaying for something. So in essence, the PE ratio at the end of the day will help us determine how overvalued or undervalued a particular stock is. Now, there are two factors that go into the PE ratio. There is the stock price and the earnings per share. And if we take a look at the equation that we have, and again, don't worry, we're going to break everything down so you can understand this and it'll be second nature. The PE ratio is the price per share, which is the stock price, divided by the earnings per share. Now, you might be thinking, okay, I know what the stock price is. I can just look at it, but what about the earnings per share? Now, the EPS will tell you how much net profit a company is making per each share that they have outstanding. And it's a simple formula. EPS or earnings per share is equal to the net income divided by the outstanding shares, the shares outstanding of a company. Okay, so taking a look at an example, if we want to figure out the earnings per share, the earnings per each share of that company, how much they are making per each share that they have outstanding, we plug in the numbers. So in this case, let's say that a company's net income is $10 million, okay? It's a pretty small company. It makes $10 million of net income, and it has 1 million outstanding shares. Right? So we're going to plug all of this into the EPS equation for us to get the EPS in order for us to get the PE ratio. So $10 million divided by 1 million shares. And we can do that simple math. Do we need the calculator for that? Or do we just do it in our head over here? 10 divided by 1 is 10. Is that right? That's right. So 10 bucks. This is the EPS for this company. So this means that for every share that they have, they are essentially making $10. Now, obviously, the higher this number is, the higher the EPS is, the more money that the company generates per shares that they have, right? This is pretty self-explanatory. So if we take a look at company X versus company Y, company X has an EPS or earnings per share of $10. Company Y has an earnings per share of $5. Company X is actually making twice as much per share as company Y is. So if you were to look at this, maybe you would say that, oh, this is making more money. Company X is doing double the amount for the amount of shares that they have outstanding. I'm going to put this on the list rather than this. If you were to compare the two, if you were going to invest in this versus this might be a nice little metric to look at when starting your valuation process. All right. Step number one, getting that EPS. Look at the EPS. You say, okay, $10, not bad. Let's take a look and plug this into the PE ratio and see if it makes sense to further invest in this company. So let's take a look at this scenario. We have a stock with a price of $150 per share. So you can go ahead and buy one share for $150. And again, you might look at this and it will tell you essentially nothing of what the company is worth. So let's plug into this equation for the PE ratio. Let's plug in the earnings per share. So we put on the numerator side, which is the one above, price per share, 150. And then on the denominator side, the one below, is the earnings per share. So we already calculated the earnings per share is 10. We plug that in. And now we have the PE ratio is equal to the price per share divided by the earnings per share. And we have a final PE ratio of, what is it? 150 divided by 10. That is, take out the zeros, we have 15. 15 is our PE ratio for this company. This will effectively tell you how much investors are willing to pay for each dollar a company earns. Now, the result, in this case 15, is known as the stock's multiple or earnings multiple. You might have heard this term before, right? In other words, for every dollar of earnings the company generates, investors are willing to pay $15. Now, we can take this number, this multiple, and we can make some assumptions about the stock to better help determine if we should invest in it or not. Now, the first is whether the stock is overvalued or undervalued. See, we as investors, we're always trying to buy stock at a good deal, and that means trying to find companies that are undervalued. Now, if a stock has a low PE ratio, that can mean that the stock might be undervalued compared to its actual earnings potential. Now, you can take a look at a low PE and say, I'm getting a really good deal on this, right? I'm only paying X amount for the company's earnings. Now, on the flip side, a very high PE ratio might indicate that the stock might be overvalued. If investors are paying more and more for earnings of that company, at some point, what you are paying will be much higher than what you get. It's like you ever pay for something and then you get it and you're like, that's it. That's all I got. I paid this amount and that's all I got. Well, in that case, that particular item might have quote unquote a high PE ratio. Well, then the question is, why would somebody pay a high multiple for a company? Well, this is where the growth potential comes in. Now, some might argue that a higher PE ratio is okay because that just means that the market really believes in that company and it expects that company's earnings to catch up to what we are paying today for it. In other words, investors expect the company to grow. Now, having a low PE number might mean that the market might expect that company to experience slower growth or even a decline in its earnings because they are willing to pay a less amount per their earnings. So you might look at that and say, these earnings, they don't excite me as much, right? So I'm not willing to pay as much for it. So it could be a double-edged sword sometimes. Now, another important factor to consider is the risk versus the stability of the company. If a company has a high PE ratio, that can mean that the company is higher risk. Now, usually higher PE stocks, like we mentioned, are expected to grow rapidly. Now, usually you see this with hot tech stocks, right, on the market. But the risk comes in when they don't grow and meet those expectations, right, those earnings expectations. Then investors will lose faith and sell off the company. Now, on the other hand, a low PE ratio can mean that the company has stability and it is maybe more of a reliable investment to you. So instead of rapid growth, you have a more slow and steady wins the race approach, right? Now you see this in a lot of mature companies, often value companies. They have lower PE ratios because they're not expected to grow as much. Now, one thing that is very important to keep in mind when comparing PE ratios of different companies is that you only want to compare companies in the same industry. So you want to compare tech companies to other tech companies, energy stocks to other energy stocks, etc. Now, this is because every industry has its own standard and has its own average multiple associated with that industry. So you would never compare Apple's PE ratio to, let's say, Coca-Cola's PE ratio, because those industries have nothing to do with one another, and therefore you would have different expectations for each. So what you are going to want to do is search for what the average PE ratio is for the industry or sector of that company, because every industry has different averages, and then you can take that average as a sort of benchmark to determine whether or not the multiple for your particular company is high or low. Now, this is where you as an investor comes in. You have to understand what this PE ratio means, what it tells you about the company, and then you have to take a look at your own investing philosophy and see if that PE ratio matches up. But understanding all of this and understanding what a company actually makes relative to all of these things that we talked about is very important when you go and invest in any company. So as long as you understand all that, we can keep going. The third step in this valuation process is going to be taking a look at a company's free cash flow. Now, what is free cash flow? Well, free cash flow is simply the cash that a company has left after it spends money on maintaining or expanding its asset base. In simple terms, it is the cash that's available to the company for things like paying dividends, repurchasing shares, or reducing debts, reinvesting in their business, etc. Now, the formula for the free cash flow is pretty straightforward. Free cash flow, or FCF, is equal to the operating cash flow minus the capital expenditure, or CapEx. All right. And you've heard these terms before, but now we're putting it into a nice little formula to get the free cash flow. And understanding this free cash flow and knowing what to look for, which we're going to go into in just a second, will really give you a better sense of whether this company is making money, can this company grow, and should I invest in it? Now, operating cash flow. So operating cash flow is the cash generated from the company's core business operations. Now, capital expenditures, or CapEx. Now, these are usually the funds used by the company to buy, upgrade, or maintain physical assets like buildings, equipments, machinery, all that kind of stuff, okay? So CapEx. Now, free cash flow is important because it shows the true profitability of a company beyond its net income. Now, a company could have a positive net income, but if it's not generating enough cash after investing in its business, it might then struggle to grow or meet financial obligations. Now, think of it like this. A company should be a cash machine, right? This is what we want from a company, to produce as much cash as possible. So the free cash flow tells us how much cash it's actually producing after it's done paying for all the stuff that it needs to continue running that business. The more it has left over, the more cash it has for growth. And what does growth of a company mean? Well, hopefully it means an increase in stock price, right? And what does that mean? Profit for us. Now, when valuating the free cash flow of a company, here are some things to look for. Now, these are the things that you're going to want to look for when you're going into all the records of the company and taking a look at the free cash flow, okay? Because we can look at it and just stare at it and be like, okay, but now what? So let's take a look at these points, right? The first point is consistent growth in free cash flow. Now, you want to see free cash flow growing over time, hopefully year over year. That free cash flow number increases over time. Now, if a company is consistently increasing its free cash flow, that is a strong signal that it is becoming more efficient, right? It's using that money more efficiently. Now, the second thing that we want to look for is a positive free cash flow. This is very important, this word here, positive, because you can have consistent growth of free cash flow, but if it goes from negative to a little less negative the year after that, so on and so forth, and it's not in the positive territory, well, then what are we doing, right? So positive free cash flow, this is a good sign. This means that the company is generating more cash than it is spending. That's obviously good. Now, if the company has a constant negative cash flow, this might mean that it is borrowing to fund its operations or relying too much on external capital, which could be a red flag. So point number 3, free cash flow should be higher than net income. Now, what does this mean? So net income can be affected by accounting practices, but free cash flow gives us a clearer picture of how much real cash the company has available. So if free cash flow is consistently higher than the net income of the company, well, that is typically a good sign of a healthy cash generating company. And again, this is what we want. We want that company to continue to generate cash higher than the net income. Now, the last thing that I want you to pay attention to when taking a look at the free cash flow is the capital expenditure, or CapEx spending, the spending on what it takes in order for them to maintain and run their business. Now, a high capex could mean that the company is investing in high growth opportunities, but if it is too high and the free cash flow is low, that might indicate that the company is overextending itself. So, the free cash flow of a company is all about the financial strength of that company. Strong free cash flow means that it is financially healthy, and a weak cash flow, you take a look at all of that and you're like, I don't like what I see. This could mean that the company is struggling to make money or it is struggling to at least hold on to that money, right? So it's obviously a very important indicator of a company's long term sustainability. We as investors want to give the companies that we're invested in a long runway to expand, grow, and increase their share price for us. But if a company is stuck with very little cash flow over a long period of time and they can't seem to increase that year over year, well, that can tell us to be cautious when investing in this company. So for me, when I want to invest in a company, these three factors are some of the first things that I look at. I want to make sure that I understand the enterprise value of a company rather than just taking a look at the market cap. I want to understand that PE ratio and factor in whether this multiple is aligned with my investing philosophy. And I want to make sure that the company is actually making money and has been doing so year after year for a long period of time. And this generally gives me a sense that they know what they're doing, they can make money, they can use that money to grow the company. Now, this all should be the bare minimum of research that any investor should be doing before investing their hard earned money into anything. Because at the end of the day, we have to have confidence in our investments. We don't just go in blind and create a stock portfolio and just hope for the best, right? Remember, our goal at the very least is to try to beat the market. And I personally think it is possible to do so. Now, there is a lot more that goes into beating the market than just what we learned today. Now, funny enough, I did an entire video of strategies that the world's famous investors use to beat the market. So if I were you, I would check out this video next to learn how to beat the market. And after that, you can go down the rabbit hole of my other investing videos. Thank you all so much for watching, and we will see you in the next video.